how would I invest $100,000 considering that you actually have $100,000 as a whole portfolio? This is part of a series where we discussed if you had $1,000, if you had $10,000, if you had $100,000, what we're discussing today. And we're gonna go through the different investment options, what to consider and what to pay attention to. So stay tuned, we're gonna have a lot of fun. Hey, welcome to today's video. My name is Julian. On this channel, we discuss all the wonderful world of investing, mostly Bitcoin, mostly decentralization. It's all about getting crypto fit, understanding this world of cryptocurrencies and what it all means. But we discuss things like stocks, precious metals, and all the cool and crazy things, how to kind of put your money at work in a smart way with a long time horizon. And that's kind of the ideas behind all this. Now, today I want to discuss the next video in this entire series. So we discussed $1,000, $10,000, and now we're going to discuss $100,000. So how would you put $100,000 to work as a whole? So if this is your entire kind of capital, and that's kind of important to understand because in this whole mix, it's not really about if you have $1,000 to invest right now. It's really about the entire portfolio. You will see kind of how this works. And I'll give you a bit of my thoughts. Obviously, always interested to hear your thoughts. I'm not an investment advisor. I'm just kind of putting some thoughts down. If you want to have higher amounts, if you want to have $1 million, 10 million, 100 million, we can discuss those as well. 100 million, I don't have personal experience in, but I can kind of share experience from friends that I have who have 100 million as a portfolio. And that's kind of relevant in the whole spiel if you kind of want to see it this way. So without much further ado, let's dive in. I have my writing pad here. We're going to discuss a couple of topics, and so let's do this and see how this all works. Now, remember, so we're starting off with 100K. Now, a couple of things that we discussed in the past, and I just want to kind of cover this as well. A key question is always investing in others versus in yourself, right? Always kind of ask yourself this: what gives you a higher return? For example, if you invest $1,000 in stocks, man, maybe you make $10,000, right? That's 10x. That's really, really a lot. Maybe you invest $1,000 in Bitcoin, you can make 100x. Like you could do $100,000. But hey, you invest $1,000 in yourself, you can make $1 million every year over and over and over. Now, the focus here is on can, right? No one knows if, but just kind of understand this, right? The importance of investing in yourself. I think that's the very key thing, and I'll keep kind of stressing that. So especially with $1,000 or $10,000, I think that's important. Also with 100,000, that's flexible. I think generally maybe we start at 50K where this starts to become relevant, and maybe goes up to 250K, right? So that's kind of, it's a variable. So don't see it as it's 100K, and that's kind of important. Now, why is this number so relevant? Because if you actually have a really good portfolio strategy, and at the end that's what it comes down to, then there is the chance of, I don't know, making 7 to 10% per annum. I think that's realistic if you kind of diversify, right? You can go higher for sure, then you take way more volatility in, but I think that's realistic. And then we're talking about 7 to 10K per year in return, and that's difficult to cover in additional income, because that's actually an additional month, maybe 2 months of additional income. So that's when stuff starts getting relevant, right? Before this, let's put an example of 50K. So here we're talking about, I don't know, 3.5K to 5K per year in return. And so the question is always, does it make sense to invest time, energy, money into something that gives you around 3.5 to 5K, where maybe it makes more sense to invest this in yourself? And I always think a bit around the 50K mark, it starts kind of tipping over into investing into other things, where prior to that, it probably makes more sense to invest in yourself in skills. So we're not talking about your own business right now, we're really talking about in yourself, your skills, your capabilities, and so on. Great, but so now let's kind of discuss this through, right? The very first part that you have, and I have 10 things that you can invest your money into, and so 10 things. And we discuss what I do right now. And the key is, so we're recording this beginning of May 2020. That's a key part in understanding this entire philosophy here, because stuff changes, right? You need to stay up to date on this. So the very first one is obviously fiat or cash. A couple concepts here. I definitely would have a strong amount in cash right now. Buffett has an all-time high right now. I would also keep some part in cash. Especially you want to have probably more runway than not at the moment, especially in these times. I would not be totally opposed in having 6 to 12 months in runway. Now remember, we're talking about a 100K portfolio. So this might actually mean, depending on how much you're spending, right? So let's say you need around 2,000 to 3,000 a month. Hey, we're talking about 20 to 30K maybe here, right? I wouldn't be totally opposed in having maybe a third in fiat right now. Now I know people are screaming and they're like, but what about Dalio? Dalio says cash is trash. Yeah, Dalio talks about millions of dollars portfolios, billions of dollars portfolios. He doesn't talk about a $100,000 portfolio, right? So keep stuff in perspective. Also, keep stuff in perspective and hedge your downside first, right? If you don't make a big return on 20K, let's say that's $2,000 a month that you're missing out on, $2,000 a year, keep stuff in perspective. You cannot apply the principle. That's what I always say. That's why someone with 100 million is going to invest very differently to someone that invests 100,000. For example, a person with 100 million puts aside $1 million, which might be a runway for an entire year, but it's 1% of the entire portfolio, right? Cash is trash. In that case, yes, applies. Maybe that person says, you know what? I want to have a runway for 5 years. I'll put away $5 million. That's sitting in cash. $5 million. Now that's more than someone with $1 million even has as an investable asset. But that person with 5 million says, yeah, Dalio cash is trash. That applies, but I'm actually putting away more than someone with $1 million. But it is a runway for, let's say, 5 years, right? So just kind of keep things in perspective. So I would probably, with a $100,000 portfolio, I want to have a significant runway right now in fiat and cash. 6 to 12 months, probably more on the high side. I prefer to stay nimble and safe. I know some people who didn't manage to put like money to work now in March. They might have even 50% here, right? I get it. Cash is trash. Screw that. You have very little money. $100,000 is not that much. I get it. You think it's a lot, but at the end you need way more in order to retire. So cover your downside. Very, very, very important, especially in times like these. So that's key. Let's talk about the next one, and that's marketable equity. Marketable equity, or basically what you consider stocks. So the reason it's marketable equity is because you can sell it straight away. So it's liquid, right? So that's key. Interesting part, because obviously probably at these levels, I would probably go more for ETFs. But the key thing on ETFs is you want to do dollar cost averaging. So the reason I would do dollar cost averaging on ETFs and not on individual stocks, because it's just not worth the extra work. So the average return of S&P 500 is, let's say, 7 to 8% per year. But so the thing is, okay, you might find the extra stock that does 20% per year, and this like sounds a lot, but on the total amount, it's not so much. So I would probably here go way more for ETFs and dollar cost average and focus more on time. I think ETFs are going to underperform over the next couple of years compared to a lot of individual stocks. It's just going to be very difficult to find those individual stocks, and it's going to be tough to kind of get in those. Now, the key question obviously is how much should you put into stocks? Now, that's obviously a major, major question here. I would probably dollar cost into this. Let's kind of look at the numbers at the end, but just kind of keep this in mind. Let's talk about Bitcoin, and I really significantly put Bitcoin here because if you go into other cryptos, I would keep a very small amount. Majority should probably go into Bitcoin. Here, depends, right? The big mistake is 0%. The Sharpie ratio dictates around 6%. That's kind of the mathematical optimum over the past 10 years. I would probably go a bit on the higher side right now, right? I would probably move here and say 10 to 20% might be an interesting amount right now, pushing more to the higher side. I'm someone who pushes way more on the higher side on Bitcoin right now, just because I believe going forward, it could be a very interesting one, right? Stocks, the percentage, man, it has a lot to do with your risk tolerance, has a lot to do with volatility, but let's just kind of understand, like, we're gonna balance it out at the end. So the next one is bonds. Now I know everyone kind of says bonds are trash People say this all the time. I'm so glad I never listen to the public. I always kind of make up my own mind. Simple is because bonds performed so well over the, like from end of 2019 till beginning of 2020. And everyone is saying bonds are trash. At the moment, people say the same thing. Now, I think, again, probably putting a lot into bonds doesn't make much sense. And again, probably with $100,000, I wouldn't put much into bonds at all. I think it's completely irrelevant. I think you can easier have it in cash. So probably at this level, I would probably put 0 into bonds because you have other ways to deposit your cash, right? Most accounts are insured up to this amount. So, and cash and bonds in a crisis, in a deflationary scenario are the strongest things. So if you want to cover your deflationary scenario in this, with this small, relatively small amount to invest in, I would probably go 0% for bonds. Now, the larger your portfolio goes, I think up, like after $1 million, you kind of need to put money into bonds because you cannot trust the bank anymore. So that's the key thing. So it's suddenly, it's not FDIC insured and so on. So kind of keep those things in mind. With $100,000, I would probably not play much around with bonds. I would really focus more on keeping stuff in cash rather than having it in bonds. Yeah, another thing you could do here is peer-to-peer, but see, this is very, very different, obviously, from a risk perspective. Just kind of keep this in mind here a bit. Yeah, so next one is gold. Again, I'm really going for gold and not so much for Bitcoin here. I'm really kind of going for gold. Gold, not so much for silver. Now, silver is basically going for alpha, kind of outperforming gold. Gold is the better. I would probably go more for gold here. If you want to have a gold-silver ratio, then I would probably go for an 80-20 split if you want to. But again, the question is, will silver outperform gold? I know people say it will. Investment, time, energy, relatively small investment amount. Not sure if it's worth the time. I would probably do other things, right? But so let's talk about gold. I would probably put into precious metals. I would put a portion in there, right? I think at the moment I would probably put 7.5%. That's the Dalio recommendation. So yeah, I think that kind of makes sense in the whole kind of grand scheme of things here. So yeah, why not? I think that makes sense. Great. Let's discuss a couple of other things here. We have commodities, oil, commodities, and so on. You should definitely have something in there, right? And you can see already it's getting slim here with the percentages. Yeah, I don't know, probably put 5 to 7.5%. That's kind of the Dalio recommendation. I think especially at these levels, if you're a long-term hodler, it kind of can make sense on those kind of things. Then we have collectibles. Now here we're getting to the very different part, right? So now we're talking about illiquid stuff, right? Collectibles, I'm not putting anything in there. Just really, really risky in my opinion at these kind of levels. Yeah, just kind of keep this in mind. I think that's just really, really, really important. Now we have PE and venture capital, venture equity. That's liquid stuff, right? So that's really, really illiquid. You have to start being very, very careful depositing any kind of significant amounts into all this, because if you start putting money into this right now, just keep in mind, that can be very, very difficult and that can be very, very dangerous because you might go in there and you might not be able to get out there. So I would just be really, really careful in putting significant amounts in illiquid things at the moment. And I think that's important to understand. I think so many people fall for things with potentially high returns, and then at the end, they really struggle get out of those things. So yeah, just be really, really careful when you kind of move into those things as a whole. If you kind of, yeah, if you really kind of consider those things, or if you really kind of try to play around with those things, right? I just really want to kind of explain that to people, because many times they tend to forget how these things kind of work. One thing that we discussed as well is real estate. Now, I think real estate is really, really going to crash. I think that's going to be the real bubble right now. I would wait for 2021, 2022. So wait here for 2021, 2022. I think that's going to be massive buying potential. And here the question is, well, $100,000, yeah, you might get a good deposit, so you might be able to put in 20K or something, but I think that's a major, major focus. And well, the other thing here is others. Now these are, I don't know, any kind of bond, any kind of mutual funds, any kind of insurances and so on. I wouldn't focus on this right now. So the stuff is that's again illiquid. For example, I have certain insurances that are structured in very, very strange ways. I'm not opening up any of those. So I would put 0% in this right now. So if I'm adding all this up together, right? So let's say I go on the higher side here on Bitcoin. Let's say I go here on the 7%, 7.5, so that's 15, that's 13.5. I'll put 0% in here, so that's 30.35. I don't know. Let's say in cash I'm also staying in, let's say, I don't know, 35% just to keep it simple. Then at the end, so that's 35, 55, 60, 70. So that would put 30% right now into stocks. And at the end, if you kind of look at this, right, it's actually a really, really good portfolio. That's kind of the deflationary hedge, right? So that's deflationary. That's kind of the normal environment. Hitting stocks, it's yeah, very difficult. And that's kind of the inflationary environment. So you're actually really, really well hedged in the entire thing. Again, I wouldn't probably go for bonds at this level. It makes no sense. Relatively small amount. I would stay out in the liquid stuff at the moment with the relatively small portfolio. So that's wine, cars, and so on. Private equity, venture equity. It's too small of amount. I think that doesn't make any sense. Real estate can get very, very interesting in the next 2 years, not right now. All the others, insurances, mutual funds, whatever you have there, I wouldn't open any significant new things right now. I think there's many, many other attractive things in the entire rundown that you could do here. Yeah, so that's kind of the layout in all of this. Let me just move my picture here down so you can see this a bit better. Should be a bit clearer so you can see the entire picture here. Yeah, so these are my thoughts how I would, and I would do this actually right now, right? So if I would have, let's say, 100 grand in a portfolio, that's how I would diversify the entire thing, right? So I would keep maybe a third in cash right now. That would be my deflationary kind of hedge. This would be my kind of runway. I'd probably go into ETFs. I would dollar cost average in there with a third, and then another third I will kind of distribute over hedging for an inflation. And at the end, that would really kind of give me a good chance in winning over the long run. Yeah, and I think at the end, if you do this right, you can make some really nice returns without much effort. And at the end, at $100,000 level, remember, your goal has to be to get to a level where you can retire on. Normally, you can look into doubling your money every 10 years. That's realistic. Everything faster is good, kudos, faster. But that's kind of the timeline that you are on with this. Yeah, with this, let me know what you think about this. If you have any comments, any questions, let me know in the comments down below. Yeah, let me know if you are interested in any other videos of this entire series, how this works, and what you kind of have to consider. If you want, check out my company Cake. I'll link it down below as well. At Cake, if you own Bitcoin, if you own other cryptocurrencies, we give you crypto flow or Bitcoin flow, so you can get a very nice return on cryptocurrencies. Could be very, very interesting for you. And yeah, definitely check this out. And I'll see you at the next video. Thanks so much. Yours truly, Julian. Bye-bye.